Welcome. If you're trying to raise capital, this is the only guide you'll ever need. This is not the kind of generic advice you'll find anywhere else. This framework has been battle tested across hundreds of successful raises, and if you're willing to put in the work and follow every step I'm about to show you, you'll be shocked at how much faster you can close your round, regardless of the industry you're in. Now, fair warning, I've gone ahead and packed absolutely everything I physically can into this video, which means it's going to be a little bit longer, so bear with me. If you're just casually browsing or you just can't focus right now, no problem. Do yourself a favor, save this for when you can really pay attention. What I'm about to share could literally be the difference between closing your round or running out of runway. Let's start why this isn't business as usual. Since 2022, capital raising has undergone a massive shift. Interest rates rose, investors pulled back, valuations dropped, the high burn, hyper growth era is over. Founders who could raise $20 million with a pitch deck and a prayer in 2021, let's face it, they're now struggling to raise even just $2 million, even with solid teams and good traction. So here's the new rule. You must prove defensibility, profitability, and discipline, not just vision. So what do we mean by that? Let's break these down. Defensibility means showing that your business can withstand competitive pressure. Investors want to know what prevents someone else from copying you. This could be your intellectual property, exclusive distribution channels, regulatory moat, network effects, or even just an elite team with decades of hard-to-replicate industry knowledge. If you can't articulate why you'll win when competitors show up, they won't write the check. Profitability doesn't mean you need to be profitable today, but your path there needs to be believable. They want to see smart financial discipline, strong gross margins, and a cost structure that isn't running wild. It's no longer enough to talk about future scale. They want to know how close you are to sustainability and that you actually care about capital efficiency. Discipline is about execution, structure, and operational maturity. Is your data room clean? Do your numbers make sense? Is your cap table organized? Are you running a grown-up business or a hackathon project? And most importantly, do you treat investor capital like it's sacred? A quick story. Just last month, I worked with a founder who had an incredible health tech platform. Brilliant concept, strong team, real customers, but their deck screamed burn rate instead of cash flow. They were highlighting future raises instead of current milestones. The model assumed massive team expansion without justification. We made one key shift, just one. We restructured their messaging and rebuilt their financials to emphasize 18-month sustainability and capital efficiency. Instead of asking for a $15 million fantasy round, we presented a much leaner $12 million raise with real traction, strong margins, and defensible unit economics. And the result? Well, they secured 2 term sheets from family offices, $12 million closed in under 6 weeks. Why? Because we gave investors what they now demand, evidence that this founder is operating with discipline and maturity. This is why it's absolutely critical that you look investable from slide 1. You need to show that this business isn't just a big idea, it's a smart bet. Because in this market, vision without a plan equals risk, and investors are allergic to risk right now. So let's dive into how you actually build that investor-ready foundation before you make your first outreach. We'll start with what must be in place behind the scenes before you pitch. And here it is, the customer avatar, the investor avatar. Let's talk about this investor avatar, because this one concept alone could save you months of wasted outreach and thousands of missed opportunities. Literally, this morning, a mobile telecom team came to us trying to raise $3.5 million. That's it. They had a management team that had built out $1 billion infrastructure with some of the largest cellular providers in the world. I mean, an elite team. And all these companies that they've worked for, you've heard all of them. But they kept hearing the same thing from investors. It's not the right time. Why? Because they're pitching institutions for a $3.5 million raise. That's like walking into a Ferrari dealership trying to buy a used Toyota Corolla. It's not that your opportunity is bad, it's that you're talking to the wrong buyer. This is the power of the investor avatar. You need to deeply understand what size checks they write. Are they writing $250,000 angel checks, $2 million seed checks, $100 million private equity rounds? If you're asking a growth fund for $1.5 million bridge round, you're going to get ghosted. What stage they invest in? Some do pre-seed, others only post-revenue, and some, especially family offices, want to come in late when the traction is obvious. You need to map your company's maturity to the investor's sweet spot. We call it mandate matching, their sector focus. You might be in clean tech, but if their portfolio is heavily weighted in SaaS, you're fighting upstream. Investor pattern recognition is real. They like what they know. Their investment thesis. Some funds are thesis driven. Maybe they only invest in female-led companies. or only founders in the Midwest, or only B2B AI tools. You need to reverse engineer your list around what they believe in, their preferred traction signals. Some investors love customer acquisition velocity. Others want profit margins. Some care most about strategic IP or defensible distribution. Learn what signals matter to them and lead with that in your outreach to those investors. All of this rolls up into one key idea. You only get one shot at a first impression with the Investor Network. If you approach the wrong group with the wrong story and the wrong raise amount, you might permanently close that door. You don't need thousands of investors, you need the right 20. Your investor avatar helps you find them with laser focus. All right, now let's talk infrastructure. Before you pitch a single investor, before you send a single deck, before you ask for a single introduction, you need to have your fundraising infrastructure locked in tight. Why? Because capital raising isn't about having a great idea or a slick deck. It's about reducing perceived risk. If your materials are messy, missing, or inconsistent, you're going to lose the deal before it even starts. So let's walk through what your infrastructure needs to look like. First up, your investor data room. Think of this like your digital briefcase. This is where investors go after the pitch to do their real work. And I promise you, how organized this room is will be seen as a reflection of how organized you are. Now, here's what goes in. Executive summary, just 1 or 2 pages, what you do, why it matters, how much you're raising, and what the capital will unlock. Now, keep this updated. It's your front door. Obviously, pitch deck, the investor version. This is your formal 7 to 14 slide deck with the full storyline, key metrics, team bios, go-to-market traction, and your ask. Add version control so you know which investor saw which iteration of your deck. Financial model, 3 to 5 years. Include revenue assumptions, cost structure, gross margins, burn rate, cash runway, EBITDA, and hiring plan. A cap table. Now, more on this in a second, but just know it's there and it's coming. Legal docs include articles of incorporation, operating agreement, IP assignments, previous safe or convertible notes, board resolutions, and any subscription docs you may have. Label everything clearly. Sloppy legal equals red flag. Team bios and LinkedIn links include full bios, role relevance, prior exits or traction, and any advisors you may have. If your team has raised capital before, by all means, put it in there. Scaled startups, great. Or has industry wins, highlight that. Now, this is optional but powerful, and we use it in our firm every single day for our new capital raises that we take on. And that is a 60 to 90 second founder video. Just you directly addressing investors, the mission, the traction, and why now. And this builds immense trust, especially when you're not meeting investors face to face. Now let's go deeper on the cap table, because this is where founders make avoidable mistakes, especially at the early stages. Your cap table is a snapshot of ownership. It shows every stakeholder, founders, investors, advisors, option pools, and what percent of the company they own. But here's what many founders do wrong. They overload the cap table too early. Founders give away equity like candy in the early days. 5% to a developer, 10% to an advisor, 8% to a friend who helped them brainstorm. Before they know it, the cap table is bloated, and that kills institutional interest later. Rule of thumb, founders collectively should still hold about 70 to 80% pre-seed. Advisors should get about 5 to 10% depending on their involvement. Option pools should be carved out before your raise, usually 10 to 15%. Avoid these early stage red flags on your capital. Debt equity. People no longer involved but still holding large percentages. No vesting schedule. This signals poor legal hygiene. If one founder owns 90% and the other owns 10%, that's a signal of internal misalignment. Make sure your equity is clean, current, and strategically allocated. Also, track investor activity. Use tools like DocSend for monitoring deck opens and engagement time, Google Drive with labeled folders and permission control, Airtable or Clay to track your investor pipeline, stages, last touch notes, interest level. This infrastructure is your credibility engine. You're not just raising capital, you're managing a due diligence process. And when everything is well prepared, investor confidence skyrockets. Let's move into numbers, because this is where most founders either earn trust or lose the room. No matter how slick your deck is or how inspiring your vision may sound, investors need to see proof, not passion. And that proof lives in your metrics. So what metrics actually matter? Let's walk through the essentials. MRR, monthly recurring revenue. This is your month-over-month contracted revenue, especially in SaaS or subscription models. It's a clean, simple way to track real-world demand and growth. Burner rate and runway. This is your monthly net spend and how long you could survive without new capital. A high burn rate with little revenue big red flag. But if you've got 12 to 18 months of runway and a tight grip on your expenses, you'll be seen as a safe operator. CAC, customer acquisition cost versus LTV, lifetime value. Now, this is a big one. It answers the question, how efficient is your growth? Think of it this way. CAC is what it costs to acquire one customer. LTV is how much that customer is worth to you over their lifespan. So if you're spending $1,000 to get a customer who only brings in $800 in revenue over time, you got a problem. That's a negative ROI. Investors want to see at least a 3-to-1 LTV to CAC ratio, meaning every dollar you spend brings back 3. Gross margin. This tells investors how scalable you are. For software, you'd better be at 70 to 80%. For physical products, it might be lower, but the margin still has to leave room for growth and ops. Churn. For subscription models, this measures how many customers are leaving month to month. If you're losing 10% of your base monthly, that signals poor product market fit. Keep churn low, and investors will view you as sticky and valuable. Payback period. This answers how quickly does each new customer pay back the cost it took to acquire them. Shorter payback, stronger cash flow dynamics, more investor confidence. Now let's talk MVPs too, because sometimes your proof of traction isn't just revenue, it's validation. A strong MVP with adoption or user behavior insights can also move investors. For example, we worked with an energy tech founder out of Texas. They were pre-revenue, but built a lightweight MVP of a grid optimization tool. Using just that prototype, they secured 2 strategic partnerships and offtake letters from regional operators based entirely on MVP performance data. Now, that MVP got them a $2.8 million term sheet, no revenue, but serious traction. Investor appetite has changed. They're no longer chasing moonshot ideas. They want traction, proof, real operators. An MVP that generates partnerships is a perfect example of how that game has shifted. Whether you're early stage or growth stage, the key takeaway is this: your numbers tell the real story. Even if the metrics aren't perfect, investors want to know, do you understand your business levers? Are you improving them? Are you measuring the right things? If you can speak confidently about your numbers and tie them to your strategy, you'll move investors from curious to committed. Now your pitch, because this is where founders either win the room or they get ghosted. Here's what most people get wrong. They think pitching is about the product. It's not. Your pitch is about one thing: inevitability. The investor needs to feel like backing your company is not just a good idea, it's the obvious, inevitable move. And you do that by building your pitch on these 3 foundational pillars. Pillar 1, problem validation. You got to start by proving there's a big pain, big, specific, painful problems that people are already throwing money at or desperate to solve. Here's what you're answering. What's broken in the world? Why is this a hair-on-fire problem for your customer? What are people using now, and why does it suck? Bonus tip: use vivid customer quotes or real use cases. Show investors you're plugged into the market, not guessing from a whiteboard. Pillar 2 is market opportunity. Next, investors want to know, is this a wave worth catching? This is where you show your market isn't just big, it's active, underserved, and ready. You're answering, how large is the TAM, the total addressable market? What trends are creating tailwinds? Why is now the moment to strike? For example, if you're in AI or infrastructure or energy, this is where you frame the moment. Investors are deploying billions into the sector over the next 18 months, and this subcategory has been historically undercapitalized. Make them feel like they're early without being too early. Execution certainty. This one's the closer. Even if the problem is huge and the timing is perfect, if they don't believe you can execute, the deal dies. This is where you answer, why you? What's your track record? Who's on your team and what have they done? Show prior exits, career wins, proprietary insights, or unique access to a customer base. Even better, show how you've already built momentum. Now, what formats should you use to deliver all this? Let's break down your pitch arsenal. Deck, keep it to 7 to 14 slides, crisp, visuals, investor-focused, narrative one-pager, executive summary that tells the story, demo video if your product is visual, show, not just tell, FAQ sheet, anticipate and answer investor objections ahead of time, email summary, 2-paragraph version of the full pitch for outreach. Here's a tip: use the problem, agitation, consequence, insight, solution, ask structure in your slides and speaking. It's a storytelling formula that works because it's emotional and it's logical. Oh, and one more tactical reminder: timing matters. Know when to pitch. If your data room is ready, your traction is in, and you've been warming up investor contacts, go pitch. But if your cap table's a mess, you don't know your burn rate yet, and you haven't tested your pitch, Wait, prepare, then strike. Pitching too early can burn bridges you'll wish you had later on. Let's talk about what really closes the deal. It's not the product, it's not even the deck, it's trust. Investors don't write checks when they understand your business. They write checks when they trust that you can win. That's why we use something I call the trust curve. Every investor interaction falls somewhere along this spectrum. Here's the trust curve, okay? It starts with cold. They've never heard of you. Then they move to curious. They've seen your materials, heard your name, social media, what have you. Then they go to confident. They've verified your traction and believe in your execution. Then to the promised land of capitalized. They write the check. Your mission is to move investors up this curve step by step with every single interaction. Each touch point builds confidence or it destroys it. Let me give you a quick story. A founder we worked with in the data center infrastructure space was raising $100 million. He had the deal, had the financials, but his materials inconsistent. His updates sporadic. His answers vague. Investors stayed stuck in this curious phase. And once we rebuilt his materials, implemented weekly investor update emails, and aligned his messaging to the investor priorities, he advanced to confident and ultimately closed the $100 million raise with the lead family office who'd been watching from afar for weeks on end. Here's how you accelerate trust. Introduce the credibility equation. Trust equals results plus reputation plus communication style divided by time. Now let's break that down. Results. What traction do you have? Revenue, users, deals closed, MVPs shipped, reputation. Who's backing you? Advisors, co-investors, founders with credibility. Communication style. Are you clear, concise, consistent? Do you make their job easier? And time, well, that's the hard part. It's hard to shortcut time, but you can compress it by packing value into every investor touch point. Monthly investor updates, even before you're actively raising, just 1 to 2 emails per month with metrics, wins, roadmap progress, and asks. Respond quickly with clarity. Show you're buttoned up. Layer in the social proof constantly, quotes from customers, new hires, advisors, etc. Create strategic scarcity. Mention, we're currently speaking to 3 family offices this week. It's not hype, it's positioning. And here's the kicker. Never, ever pitch cold. Start light, start early, build momentum. Create a pre-funding relationship strategy. Reach out before you're raising. Show them progress. Get feedback. Then, when you're finally ready, you're not a stranger asking for money. You're a high-confidence operator they've already believe in. Reminder, you only get one shot to do this right. If you show up with a weak deck, poor messaging, or vague financials that investors don't just pass, they put your deal in the mental bin labeled not ready, not worth a second look. So build trust like it's the deal maker it truly is, because it is. Now let's talk about one of the most important leverage points in fundraising: warm introductions. Studies show, and our own studies here at our firm over the years have shown, that over 80% of institutional capital comes through some form of warm introduction. Not cold DMs, not email blasts, not generic pitch blasts on LinkedIn. Capital flows through trust. So here's what you do. You build a network map in 3 layers. An inner circle. These are advisors, close mentors, high trust insiders. There's a middle ring, founders who've raised, customers, past investors. And then there's an outer ring. And these are people like LinkedIn influencers, event hosts, accelerator staff, law firms, service providers, these types of people. Every single investor you want to reach is likely 2 or 3 connections away. Your job is to trace the path backward, find the shared contact, build that bridge, because when you're ready to ask for the intro, here's a simple script you can use. Hey, John, I'm working on an energy sector company that's seeing real traction currently. I've noticed we're connected to Jim, the investor. Would you feel comfortable making an introduction at some point? Keep it casual, not pushy. Now, let me give you a real-world example of how powerful this is. A founder of a rapidly growing SaaS startup came to us frustrated. He had product market fit, a lean team, strong customer retention, but his outreach was going nowhere. It was awful. He'd sent over 100 cold emails, barely any replies, 0-second meetings. When we audited his process, the problem was obvious. He was chasing big-name VCs cold without any trust bridge and without building early interest through his pre-intro engagement. We rebuilt his capital strategy. We mapped his second-degree network using LinkedIn and Clay, identified 11 investors connected through mutual operators, armed his connectors with social proof and a short deck, sent 3 light investor updates before asking for meetings. The result? Within 3 weeks, he had 5 meetings with warm intros. 2 firms submitted soft commits. He closed his full $15 million raise in just under 69 days. No more cold outreach, no more ghosting, just intelligent, capital strategy plus trust leverage. This is the game. So if you're watching this and thinking, well, I don't know any investors, you're asking the wrong question. The right question is, who do I know who knows someone who could help me get there? Bridge that gap. The magic is in the warm path. The more you lean into the system, the faster the raise becomes real. Now that you've built your investor network and you've got those warm intros flowing, right? You've got them flowing. The next move is to manage the process like a pro. Let's shift your mindset. You're not hoping to get funded. You're managing an opportunities roadmap. And that roadmap helps you visually track investor progress, stay on top of every conversation, and create the kind of momentum that leads to term sheets. Here's how we break it down inside our capital raise OS. Cold. Investor hasn't heard of you yet. Warm, they've seen your name or had light intro. Diligence, they're reviewing your deck or data room. Soft, commit, verbal interest is on the table. Term sheet sent, it's in writing, closed, funds wired, deal done, pop the champagne. Each stage has different materials, different tones, and a different goal. And most importantly, your job is to move people forward. Now let's talk about the real driver behind forward motion. Momentum. You're not just pitching investors. You're signaling velocity. Quick reality check. Investors don't want to be early. They want to be right. So what do? You engineer social proof and build perceived demand around your round. That's why we advise our clients to send weekly investor updates during their raise. Yes, weekly. It keeps you top of mind, shows movement, and builds investor confidence with every line. Now, each update should include customer growth, strategic hires, new investor meetings or follow-ups, progress on close timeline, press awards or validator shoutouts. Make it tight, 2 to 3 bullet points, easy to skim, but heavy on traction, energy, and confidence. Here's a real-world example of what this looks like in action. We worked with the founder raising for a major infrastructure initiative, a $100 million target. He had warm intros, 15 investor convos live, but it was all just sitting, zero urgency. We rebuilt his raise roadmap using this exact model, mapped investor status in a CRM, installed momentum tracking tied to actual milestones, created a rhythm of weekly high signal updates. Well, by update number 3, 2 of the more passive investors re-engaged. By update number 5, his lead investor committed $42 million. It wasn't magic, it was structure, communication, execution, and system. Now, pro tip. Treat your raise like a campaign, not a series of meetings. That roadmap is your dashboard of progress. And those investor updates, they're your engine of momentum. No one wants to invest in a project that feels static. But when you show movement, that's when people step forward. So from now on, don't just track activity, track momentum, build urgency, and above all, stay in motion. Now let's walk through the landmines, because no matter how good your idea is, these common mistakes can kill your raise before it even gets off the ground. Mistake number 1, raising too early. No traction, no product, nothing validated. You're basically asking investor to bet on vibes, and I promise you they do not do that. Mistake number 2, unrealistic valuations. Now this one hurts because it happens every single week. Founders walking in with a $20 million valuation with no traction, no revenue, and no proven team, expecting investors to take them seriously. But let me show you just how far off the rails this can go. In one of the pitch deck roast videos we've done, a real estate developer was trying to raise $260 million. No track record, no experienced executive team. Frankly, no one would have even taken him seriously at a local PTA meeting. And he wondered why investors weren't returning his calls. These investors are either MBAs or they've hired MBAs to run their due diligence team, just like our firm has. They can smell amateur hour a mile away. Don't be that story. Another example, a developer came to us looking to raise $400 million for a high concept project. Naturally, we asked him for his pitch deck. He said, and I quote, "Absolutely, we spent over $250,000 on this with our attorney. It took 6 months to get it just right. We're so proud of it. We'd love to share it with you." Well, we expected precision. Instead, we got a 42-page glossy brochure, not a single investor-facing financial detail in sight, no capital stack, no LP terms, no IRR projections, just architectural renderings and inspirational quotes. I turned to my team and I said, we just got a 6-figure coffee table book. And the worst part, he had already sent it out to dozens and dozens of potential investors. And let me remind you, you do not get a second chance with this network. Once you make a bad impression, your deal is quietly blacklisted and put on the shelf. That's how fast the credibility game moves. Mistake number 3, cap table drama. Early co-founders who ghosted, old equity holders still lingering, messy safe rounds. Investors will scrutinize this very hard. Keep your cap table clean, current, and compelling. Mistake number 4, all story, no strategy. Don't show up with a pitch full of dreams and zero logistics. No plan to acquire customers, no go-to-market clarity. That's a hard pass. Mistake number 5, weak communication cadence. Raising capital is about managing perception. If you ghost an investor for 3 weeks, that opportunity is dead. You need to manage consistent strategic outreach, even if it's just monthly updates and momentum signals. Now, here's the upside. You can recover from weak metrics. You can recover from a slow start, but you can't recover from being seen as risky or unprofessional. So treat these mistakes like a checklist and avoid them at all costs. Now, here's something that doesn't get enough attention in the capital raising world. That's bridge rounds. Bridge capital is one of the most misunderstood and most underutilized tools in the capital stack, because when deployed correctly, it's not a sign of weakness, it's a signal of strategic momentum. Too many founders treat bridge rounds like lifelines. That's not the move. You want to position it as an inflection point accelerator. So think of it like this. You're heading into a larger raise, maybe your Series A or $50 million growth round, but there's a strategic gap to fill. You need a key executive hire, final customer validation, a paid pilot or proof of concept, product market fit refinement, or even just more traction to drive up valuation. Instead of waiting and dragging out your timeline, you raise a strategic bridge to lock that down quickly. This gives your larger raise better optics, stronger KPIs, and more importantly, leverage. Now investors are walking into a de-risked story. And let me add this, in today's market, bridge rounds are more common than ever because no one wants to walk into a down round. Ever. So by using a well-structured bridge, you can extend your runway without giving up too much equity, maintain narrative momentum, and keep investor engagement high leading into your next raise. So here's the play. Keep it tight, raise just what you need, use convertible notes or safe instruments with a valuation cap, of course, and make the use of proceeds extremely tactical. We had a founder recently raise $2.7 million bridge to close 3 customer deals and onboard a CRO. Now that raise helped him increase ARR by over 40% in just 90 days. Guess what happened next? The Series A round that followed? Oversubscribed and at a higher valuation than expected. That's the kind of narrative that investors love. They don't want risk. They want proof of inevitability. Let's talk about the operating system behind a successful capital raise. Look, raising capital at an elite level isn't just about charisma or networking. It's about systems. It's about clarity, visibility, and control over every moving piece of the raise. So if you're still using scattered spreadsheets or sticky notes, it's time to level up. You need visibility into your investor pipeline at all times. Here are a few tools I recommend based on what stage and complexity you're operating at. Airtable. Think of it like a smart visual spreadsheet. Airtable lets you build custom views for tracking investors, automate follow-ups, and manage your raise like a pro-level pipeline. It's simple, powerful, and customizable. Clay pulls in rich contact data from across the web and your inbox, giving you real-time context on each investor you're targeting. It's powerful for personalization and warm outreach, especially if you're nurturing high-touch relationships. Affinity, built especially for investor relations and deal flow. Affinity is like a CRM on steroids for capital-raising teams. It tracks every touch point automatically and helps you manage relationships at scale. Using tools like these allows you to map out every investor's name, fund type, check size, and thesis, track their movement through your pipeline, cold, warm, diligent, soft commit, closed, log, notes from each call or meeting, schedule automated follow-ups and reminders, data room and deck delivery. Now for your actual materials, Google Drive works great. It's what we use in my firm for years, if organized properly. Create folders for pitch deck versions, financial models, legal docs, investor FAQs. Use permission controls wisely. DocSend, essential for pitch deck distribution. It tracks who's actually viewed your deck, how long they've spent on each slide, and whether they shared it with others. You'll know who's serious and who's not before the call even happens. Communication tools, superhuman for rapid investor email management with shortcuts, tracking, and reminders. Great if you're managing high email volume. Mixmax lets you automate cold outreach, set up email cadences, and insert pre-built templates to save time. Design tools, Figma or Gamma. Use these for deck design and dynamic slide creation. Clean, modern. These things matter. No investor wants to read a wall of text or look at outdated graphics. Automation. Zapier connects all your tools together. For example, if an investor views your DocSend deck, Zapier can automatically trigger a CRM update or a Slack notification to your team. So quick tip, you don't need to use all of these. You don't. But pick a stack that works for you and build your fundraising OS before your outreach begins. A confused founder leads to confused investors. You don't want that. But a founder who's methodical, organized, and systemized, that founder looks fundable. If you've been trying to take notes and screenshots and slides, trying to keep up, just stop for a second. I've made it easy for you. The PDF version of this entire guide, the only capital raising guide you'll ever need, is linked below this video. You're welcome. It includes every single slide you've seen with massive detail, all the tools mentioned, checklists, investor materials, structure, and more. Use it as your instruction manual. Download it, print it, share it with your team. And when you're ready, use it to dominate your next raise. Now, if you've made it this far, you're clearly serious about raising capital the right way. So here's the truth. As I've said throughout this whole video, most founders only get one shot at making a great first impression to the investor network. If you fumble the outreach, if your deck is off, if your data room looks amateur, you don't get a do-over. This is exactly why our team at Investor Ready Capital exists. We only work with serious founders who want to raise with precision, velocity, and confidence. If that's you and you're looking for a true partner, not a coach, not a consultant, but a real team who has been in the trenches, then we may be exactly what you need. We're extremely selective. Each quarter, we take on only 3 companies. They must show hockey stick growth potential, sharp execution, and a vision that fits what today's investors are looking for. That's it, just 3. Why? Because we go deep, not wide. We work side by side with our founders, not just for this round, but long term. We'll know your data room inside and out. We'll help you structure the next raise months in advance before it becomes a last-minute scramble. We'll help you engineer your capital stack, align your terms with investor appetite, and give you real-world guidance on deal dynamics as they unfold. If you want a partner in your back pocket, someone who understands your category, speaks fluent investor, and will have your back when the stakes are highest, we should talk. Because as I've said before, we're not a hireable team. We want to be there through the what's next phase with the right founders. What I mean by that is if you're raising your pre-seed, your seed, your Series A, whatever it might be now, I guarantee you 12, 18, 24 months from now, there is always a what's next. And we want to be there with you through that whole journey. And you're going to want us there through that whole journey to make sure that not only we build it with the end in mind, whether that's an M&A sell-off, whether it's an IPO, you're going to want to have a team like ours in your back pocket getting ready for that what's next so it's not a scramble and you have to do all this all over again. So I'll drop a link in the description below where you can schedule a formal session with me and my team. We'll explore your deal, assess feasibility, and if it's a fit, we'll show you exactly how to structure and execute a raise that gets results. Now, if you're not ready to work with a team, that's fine. But I should mention, when it comes to raising capital, you need to know what to avoid when it comes to making pitch decks. And if you click right here to go to the next video, you'll find out exactly what I learned after auditing and analyzing thousands of pitch decks from failed startups. So if you're even thinking about pitching investors, I'll see you in the next one right now.